Picture two people signing for the same house, the same loan, on the same afternoon. One picks a fixed-rate mortgage. The other picks a 5-1 adjustable-rate mortgage, an ARM. And right away, the ARM person feels like the winner because their monthly payment is lower. Same house, less money out the door. Here's the part most people never read closely. That lower payment has an expiration date. For the first 5 years, it's locked in. Then, on a date written into the contract, the rate stops being fixed and starts adjusting, once a year, every year, for the rest of the loan. And it can climb. So the real question was never which payment is cheaper today. It's what happens after year 5. Get it right, and the ARM saves you real money. Get it wrong, and you wake up to a payment hundreds of dollars higher than you planned for. Let's decode how a 5-1 ARM works, and the one question that tells you whether the gamble is worth it. Let's start by decoding the name, because 5-1 tells you almost everything once you know how to read it. It's two numbers separated by a slash. The first, the 5, is how many years your rate stays fixed at the start. For those first 5 years, nothing moves. Same rate, same payment, just like a fixed loan. This is often called the teaser period because the rate is usually lower than a comparable fixed loan to get you in the door. The second, the 1, is how often the rate can adjust after that. A 1 means once every year. So a 5-1 ARM is fixed for 5 years, then reprices once a year for the rest of the term, usually the standard 30. After the 5-year calm, you've still got 25 years where the rate can move. You'll see siblings too. A 7-1 is fixed for 7 years, a 10-1 for 10. Now hold that against a plain fixed-rate mortgage. There's only one rate, and it never changes. The same principal and interest payment for the entire 30 years. No switch point, no surprises. That's the trade in one picture. The fixed loan is a straight, flat line. The ARM is a flat line that gets a hinge in it at year 5. So when that switch point arrives at year 5, how does the bank decide your new rate? It's actually a simple recipe. Index plus margin equals your new rate. Lenders call that sum the fully indexed rate. The index is the moving piece, a published interest rate that tracks the broader market, up when rates rise, down when they fall. You don't control it, and neither does your lender. Most ARMs today use an index called the 30-day average SOFR, which replaced the older LIBOR index a few years back. The margin is the fixed piece, a set number the lender adds on top, locked in for the entire life of the loan and written in your contract on day 1. So at every adjustment, the only thing moving is the index. The margin just rides along. Let's put numbers on it, purely illustrative, not a quote. Say the index is at 4% and your margin is 2.75%. Add them, that's a 6.75% fully indexed rate for the next year. One wrinkle. The bank rounds the sum to the nearest 1/8%, 0.125. And every year after the fixed period, it reruns this exact recipe. Now, if your rate is tied to an index that can move, the obvious panic is, what if the market spikes? Could my payment just explode? The answer is no, because every ARM comes with built-in guardrails called rate caps. These are your single most important protection. Caps usually come as 3 numbers, and a very common structure is 225. The first is the initial adjustment cap. A 2 means your rate can rise at most 2 percentage points at that very first adjustment, no matter what the index did. The second is the periodic cap. Another 2 means in any single year after that, the rate can move at most 2 points. So it steps, it doesn't leap. The third is the big one, the lifetime cap. A 5 means your rate can never go more than 5 percentage points above your starting rate, ever. Make it concrete. Say your ARM starts at 6% with a 225 cap. At the first adjustment, the most it can climb is 2 points, a ceiling of 8%, even if the market screamed past it. And no matter how high the index runs, your rate can never exceed 11%, the 6% start plus the 5-point lifetime cap. So even in a bad market, an ARM can't go to the moon. It only steps up in capped increments and slams into a hard ceiling you knew about on day 1. One caveat, exact caps vary by loan, so 225 is common but not universal. Read your note. Caps protect you. but they still allow a big move. So let's translate all of this into the only number you actually feel: the monthly payment. Take one illustrative loan, $400,000, 30-year term, principal and interest only, taxes and insurance left out, figures rounded. 3 scenarios. Scenario 1, the fixed loan. At about 6.5%, your payment is roughly $2,528 a month. Your number for all 30 years. It never moves. That's what you're buying. Certainty. Scenario 2, the ARM at its lower start rate, around 6%. Now your payment is about $2,398 a month. Roughly $130 cheaper right out of the gate. That's the whole appeal. For context, ARM rates have lately averaged about 70 to 80 basis points below the 30-year fixed. On this loan, roughly $200 a month of early savings. Now, scenario 3, the worst case nobody puts on the brochure. Imagine your rate ratchets all the way to that 11% lifetime maximum. Your payment can climb to roughly $3,800 a month, over $1,400 a month higher than where you started. That jump has a name: payment shock. The ARM hands you a real discount early and a real uncertainty later. Which matters more depends entirely on the last factor. So here's the question that actually decides it. And it's not which rate is lower. It's how long are you going to keep this loan? Lean ARM if your horizon is short, shorter than the fixed period. It makes sense mainly if you're genuinely confident you'll be gone before it ever adjusts. You're moving in a few years, it's a starter home, or you expect to refinance before year 5. Get out before the adjustment hits, and you capture the early discount and walk away before the uncertainty shows up. Lean fixed if your horizon is long, or your budget can't take a hit. Planting roots for the long haul, or a higher payment would break your budget? Then certainty is worth paying for. A payment you can count on for 30 years. And here's the safety test that ties it together. Only take an ARM if you could still afford the payment at the lifetime cap maximum. If that worst case, the 11%, the $3,800 a month, would sink you, the gamble is too big. Lenders actually check a version of this. Under the federal ability to repay rule, they qualify you using the higher of the start rate or the fully indexed rate. So that low teaser rate is not what you're approved on. And you're owed written notice between 210 and 240 days before that first adjusted payment. For perspective, in late 2025, ARMs made up roughly 8 to 13% of mortgage applications, up from around 6% after 2008. So let's pull it together. And remember, this is educational, not financial advice. A fixed-rate mortgage buys certainty, the same principal and interest payment for the entire 30 years. A 5/1 ARM trades that certainty for a lower starting rate. It's fixed for 5 years, then reprices once a year. Index plus margin, the margin locked for life while only the index moves. Bounded by your caps, commonly 225. 2 points at the first adjustment, 2 each year after. Never more than 5 above where you started. In dollars, that's real savings early, about $130 a month cheaper at the start, and real payment shock later, potentially over $1,400 a month higher at the lifetime cap. So the gamble is reasonable mainly if you'll leave or refinance before it adjusts, and only if you could still afford the capped maximum payment. If you'll stay long-term, fixed wins. It comes down to one honest answer. How long are you keeping this loan? If this finally made the fine print on an ARM make sense, hit subscribe. That's the whole point of this channel. The money mechanics nobody ever sat you down and explained. And here's your perfect next step. Once you've settled fixed versus adjustable, there's a second mortgage fork that quietly decides how much total interest you'll pay. And it's not about the rate, it's about the length. 15-year mortgage or 30? The shorter loan can save a staggering amount in interest, but the trade-off catches people off guard. Watch the video on 15-year versus 30-year mortgages. I'll see you there.